Towards the end of 2024, US long bond rates started creeping up despite interest rate cuts. This trend continued at the beginning of 2025, hinting that a challenging environment may be laying ahead for investors in the new year. Joining me today to delve into the outlook for fixed income investors in 2025 is Assistant Fund Manager Ané Craig.
Thanks, Audrey. Before we start with the outlook of 2025, let's quickly recap in terms of the key market drivers of 2024. There were really two factors: geopolitical risk and inflation. As we know, elections dominated 2024, and particularly on the home front with our local elections in May and then the US elections in November, and we'll discuss those momentarily. And the second very important factor of market returns broader than fixed income, but particularly on bonds, was the central bank's reaction to inflation. If we look at the year in review on the local front, there was this period of really benign returns, especially in the full year context, prior to our May local elections. Inflation was actually trending downwards from February 2024, and 2024 started off the market quite positive on interest rate cuts by developed markets, including Europe and particularly in the US. There was a bit of a reversal in that view around March, but really again returns were masked locally because of this election risk priced into our markets. Then, of course, the better than expected results and the formation of the Government of National Unity saw both our equity markets and bond markets perform very, very strongly from the start of June. And this is also a time where the market was looking at up to 25 basis point cuts in the US federal funds rate. That's the US central bank rate. So it really was a fantastic environment for bonds. Then, looking back in hindsight, it's easier to say than at the time. It looks like inflation actually bottomed in September 2024. And after that, inflation started coming through the system again. US labor market appeared quite strong, and you saw a reversal of the expected Fed funds rate. That means that the market started pricing out some of the interest rate cuts that it had originally projected. And again, it was quite a tough environment for bonds. Then you overlay President Trump's policies, which generally is not a great cocktail, with protectionism, tax cuts, tariffs, as we know. These aren't great factors for bonds because they are particularly inflationary. The lessons that we learned from 2024 is one can be very constructive on an asset class and have exposure to it, like South African bonds, for example, had a phenomenal year, returned over 17% and performed equity markets. But it wasn't smooth sailing or a straight road. So if we look at the month-on-month returns for SA bond, you can see that there were 3 months of negative returns, particularly strong in March and October, and those returns were driven by changes in expectations for US interest rate cuts. So what we've learned from 2024 is, though the overall picture can look really positive, you actually have to be quite dynamic in taking risk and managing that downside throughout the year.
So with that in mind, and as we look ahead into 2025, what developments do you anticipate in the markets?
So we think the drivers are going to be very similar to 2024. It's again going to be geopolitical risks and inflation. So as we mentioned, we think inflation has bottomed. It doesn't necessarily have to come roaring back, but cyclically we're at a different point now with inflation a bit stronger. And where geopolitical risk in 2024 were principally around elections, in 2025 they are around policies. And we've spoken at length, as has the entire market, about President Trump now inaugurated and what that could mean for global growth and inflation. But also on the local front, policy messaging and policy enactment will be critically important. We, post the formation of the GNU, have the potential to have higher GDP growth from a structural point, And that will particularly be led by an ease in infrastructure constraint. So we've had an absence of load shedding for over a year, and there's early signs that the constraints in our rail and logistics systems are alleviating. But then also on the policy front, you have potential for infrastructure spending, which is also quite growth positive, and that's both by government as well as by the private sector. And you can see that the market's consensus view is for South African growth to be around 2% this year. We think that could be a little bit higher, but it is quite, as you said, a challenging outlook that we see for 2025 because, again, of geopolitical risks globally. And as we saw through 2024, if the US bond yields widen or increase, so do SA bond yields, which means prices go down. So again, this is where you really want to focus on the construction of your portfolio and to not have singular views or drivers of return, because it's going to be a potentially challenging environment to manage. And maybe just a final point in terms of the 2025 outlook. We are cyclically at a slightly different point than last year. As we said, inflation might have bottomed and is ticking up a little bit. But we should also see a mild cyclical recovery in things like consumer spending this year. Not a lot of interest rate cuts left, potentially just one in SA. But that should provide a little bit of relief. And if you combine that with a bit more business confidence and consumer confidence, that should be reasonably positive for growth in terms of consumers and fixed capital formation spend.
So given this challenging environment that you see lying ahead, where do you see returns in fixed income markets coming from in the year ahead? And then crucially, what should investors be bearing in mind when looking at their portfolios?
Yeah, great question. So we still like South African bonds. They are giving you a yield of between 10 and 11%. If we see inflation in the 4 to 5% area for this year, the market's looking at about 4.5%. Means you're still getting real returns, so that in turn above inflation of about 6%. That's very attractive. However, as we said, the road isn't linear, challenging environment ahead. So those returns are probably going to be quite range bound, and your real double-digit return potential from that would result in call it a reduction in the South African risk premium, things like fiscal consolidation, etc., where you see our entire yield curve shift lower, which is fantastic for bond prices. That story is probably a bit deferred now. But your income yield is still very good from nominal bonds. Another asset class we like very much is NCDs. Those are what wholesale investors like ourselves can get from bank deposits. And those are really nice to complement a portfolio. We're looking at yields of 8.5% to about 9%. They provide a bit of stability to portfolio yields, and we think, again, offer really attractive real returns at the moment. High quality credit should also do well. 8.5%, 9% yields are what we're expecting. And then growth assets that did very well in 2024, namely listed property, returning over 29% for the year, will probably face a few more headwinds this year. Property does particularly well in the face of interest rate cuts. As we said, we might be at the end of the cutting cycle or close to, in which case the cyclical boost for listed property isn't going to be there. The thing that investors need to bear in mind for this year is that they want to look at a product that has a long-term track record of giving investors access to attractive market returns, but through managing the downside as well. When we're looking at real returns of above 6%, the opportunity cost of sitting in cash is very high. So you want to be invested in the market, but you also want to protect that downside. It's a year of potential challenges lying ahead, again, potential uncertainties lying ahead. So that long-term proven track record and ability to be able to access market returns when they're available, but protect capital and manage the downside is going to be critical.
Ané, thank you so much for joining me today and taking that look ahead into what is shaping up to be a challenging year for investors yet again.
Thanks, Audrey.